Hi Jim, I've been trying to gauge market volatility in Forex trading. Are there any specific indicators or tools that can help me with that?
Hi Sarah, absolutely, there are several indicators and tools that traders commonly use to gauge market volatility. One popular indicator is the average true range, ATR. It measures the average range between high and low prices over a specific period, providing an indication of the market's volatility. A higher ATR value suggests higher volatility, while a lower value indicates lower volatility.
That's interesting. So, the average true range can give me a sense of the volatility in the market. Are there any other indicators or tools I should consider?
Yes, another commonly used indicator is the Bollinger Bands. Bollinger Bands consist of 3 lines, a simple moving average, usually 20 periods, and 2 standard deviation lines above and below the moving average. The distance between the upper and lower bands expands and contracts based on market volatility. When the bands widen, it suggests increased volatility, and when they contract, it indicates decreased volatility.
I see. So, Bollinger Bands can visually represent the volatility in the market by expanding or contracting based on price movements. Are there any other tools or indicators worth exploring?
Absolutely. The Volatility Index, VIX, is another useful tool for gauging market volatility. The VIX is often referred to as the fear gauge, as it measures the market's expectations of volatility over the next 30 days. It reflects investors' sentiment and can provide insights into the level of fear or complacency in the market.
That's intriguing. So, the Volatility Index can provide an overall sentiment regarding market volatility based on investors' expectations. Are there any other tools or indicators that traders use?
Yes, some traders also use the Average Directional Index, ADX, to measure the strength of a trend and indirectly gauge volatility. The ADX ranges from 0 to 100, with higher values indicating a stronger trend and potentially higher volatility. It helps traders identify whether the market is in a trending or ranging phase.
That's helpful. So, the Average Directional Index can assist me in assessing the strength of a trend, which can indirectly reflect the level of volatility. These indicators and tools seem quite valuable for understanding market volatility.
Indeed, Sarah. These indicators and tools can provide valuable insights into market volatility, helping traders make more informed decisions. However, it's important to remember that no single indicator can predict volatility with absolute certainty. It's always a good practice to combine multiple indicators and tools for a more comprehensive analysis.
That's a great point, Jim. I'll keep that in mind. By combining different indicators and tools, I can get a better understanding of market volatility. Thank you for sharing this information.
You're welcome, Sarah. I'm glad I could help. Remember to experiment with different indicators and find the ones that align with your trading style and strategy. If you have any more questions or need further guidance, feel free to reach out. Happy trading!
Absolutely. I've been hearing traders mention the term pips in Forex trading. Could you explain what pips are and how they are used?
Hi Sarah. Sure. Pips are a common unit of measurement used in Forex trading to denote the smallest price movement in a currency pair. The term pip stands for percentage in point, or price interest point. It represents the 4th decimal place for most currency pairs, except for pairs involving the Japanese yen, where it represents the 2nd decimal place.
So, if I understand correctly, pips represent the smallest increment in price movement for a currency pair. How are pips used in trading?
That's right, Sarah. Pips are primarily used to measure and calculate profits and losses in Forex trading. When a currency pair's price moves by 1 pip, it means there's a very small change in the exchange rate. Traders often refer to pips to determine the potential gains or losses in a trade and to calculate the risk-reward ratio.
That's interesting. So, pips are used to quantify the profit or loss potential of a trade. How can traders calculate the value of a pip in monetary terms?
The value of a pip in monetary terms depends on the lot size and the currency pair being traded. For most currency pairs, a standard lot size is 100,000 units. So, to calculate the value of a pip, you can use a pip calculator or a simple formula. Pip value equals 0.0001, exchange rate, lot size.
I see. So, the value of a pip is influenced by the exchange rate and the lot size. It's important to calculate the pip value accurately to determine the potential profit or loss in a trade. Are there any variations or exceptions when it comes to pips?
Yes, there are some variations and exceptions to consider. As I mentioned earlier, currency pairs involving the Japanese yen have a slightly different pip calculation. In these pairs, the second decimal place represents a pip. For example, if the USD JPY moves from 110.50 to 110.51, it means it has moved by 1 pip.
I understand. So, the pip calculation differs for currency pairs involving the Japanese yen, where the second decimal place represents a pip. It's important to be aware of these variations when trading different currency pairs.
Absolutely, Sarah. Understanding pips and how to calculate their value is essential for risk management, position sizing, and overall trade analysis. It's a fundamental concept in forex trading that every trader should be familiar with.
Thank you for explaining pips, Jim. It's clear now how pips are used to measure price movements and determine potential profits or losses. I'll make sure to consider pips in my future trades.
You're welcome, Sarah. I'm glad I could help. Remember to always factor in the spread, which is the difference between the bid and ask price, as it affects the actual entry and exit levels in relation to pips. If you have any more questions or need further clarification, feel free to ask. Happy trading!